On financial social media, you'll see someone claiming they made thousands in minutes using a double bottom or head and shoulders chart pattern. They sell the idea that a geometric triangle drawn on a chart can guarantee a stock will go up. The lines cannot predict the future. A stock chart is actually a historical record of mass psychology. It records the exact moments where greed overpowered fear and where fear wiped out greed. We are going to strip away the noise. We will take a blank, confusing line chart and turn it into an actionable trade plan by identifying the areas where big institutions are actually putting their money. Focusing on raw emotional data allows a trader to stop searching for a crystal ball and begin managing risk based on the high probability footprints left by the crowd. Let's look at the data. Step 1. Switch your charting software from standard line charts to Japanese candlesticks. Line charts only show where a stock closed at the end of the day, which hides the intraday war between buyers and sellers. Every candlestick represents a specific window of time. The solid-colored part is the body. This shows the gap between the price at the open and the close. Green indicates the price rose during that window. Red indicates it fell. The thin lines sticking out of the top and bottom are the wicks. They represent the absolute highest and lowest prices the stock touched during that time frame. Think of this specific candlestick as a rope pull match. The massive upper wick means that buyers were highly aggressive and pushed the price way up. But before the clock ran out on this candle, sellers stepped in with force and slammed the price all the way back down. That long wick is a literal footprint of rejection. By understanding these wicks, you start seeing exactly which side is losing momentum in real time. Step 2 involves mapping out support and resistance. These are areas on a chart driven by collective human memory and behavioral economics. Support acts as the floor. It is a price level where a falling stock historically turns around because buyers remember that specific price as a bargain. Resistance acts as the ceiling. Rising prices stall here because buyers who bought at the previous top are looking for any chance to sell and break even. Human memory operates in ranges, not exact pennies. Use your charting tools to draw a thick rectangle rather than a thin line to map out these zones. Think of a resistance zone like a wooden door. If a stock hits a ceiling 4 or 5 times, it indicates that buyers are aggressively knocking on the door, wearing the barrier down with every impact. When that resistance finally shatters, you get a breakout. Notice how the price pulls back slightly. That old psychological ceiling often converts into a new baseline floor. Utilizing thick zones instead of thin lines keeps you anchored to the true psychological boundaries of the crowd, preventing you from being shaken out by normal market volatility. Step 3 introduces volume. This is the total number of shares exchanging hands during a specific time frame, providing a way to verify the conviction behind a price move. If the price breaks through resistance, but the volume bars at the bottom were tiny, you are looking at a retail-driven trap. This price move will likely fail because institutional players are not participating. On the right side, the candlestick breaks resistance alongside massive, towering volume bars. This high volume confirms that large institutions, the mutual funds and hedge funds, are moving their capital. Making volume verification a non-negotiable step ensures you commit your capital only when the institutional giants are actively paving the way. Step 4 is a reality check. Even elite professional traders only win about 55% of their trades. You must draw a horizontal stop-loss line right beneath your validated zone the moment you enter a trade. This line is an unemotional exit trigger. If the price hits it, the probability of the trade has changed. You execute the exit immediately to cut the loss. A rigid stop-loss transforms the trade into a calculated probability, removing the impulse to hope for a reversal when a trade goes wrong. This integrated strategy uses candlesticks to see the tug-of-war, thick zones to locate the crowd, volume to confirm institutional movement, and a stop-loss to protect your capital. You are now reading the deliberate visual footprint of institutional activity instead of chasing that social media hype. Open your charting software, pick a stock you're monitoring, switch to candlesticks, and apply these 4 steps. Mastering these foundational mechanics provides a framework to filter market noise and base your financial strategy on evidence rather than emotion.